Hey, what's going on, guys? Greg Helbeck here. Thanks for tuning in on episode number 3 here. I'm here with my accountant here, Andrew Kabatchnick out of White Plains, New York. He is a CPA and specializes in real estate investment taxes. So, Andrew, thank you for coming on the show today.
Thanks for having me. I really appreciate it.
No problem, no problem. So let's get this started off with a little bit of your background, kind of how you got started in accounting and just kind of your backstory.
So as most accountants, we're a little nerdy, right? And I took my first accounting class back in high school. And I kind of knew, like, after the first or second day of class, that this is what I was going to do, right? When I was like 15. I always knew I was going to have my own business from even before that. I just didn't know what it was going to be until I walked out of that class, right? I had my first internship. This was like maybe close to 20 years ago, probably. Went off to college, majored in economics, and then took my accounting classes. Went off to law school for a year, and thankfully I realized it wasn't for me. And here I am, started studying for the CPA exam. This was probably 2010 when I started studying. I think it was over the summer when I finished my classes. I got licensed in 2012. And I've been since I got licensed, I started picking up some clients here and there, just like most of us do, really.
Sure.
But I fully went on my own. I guess it was about 2 to 2.5 years ago.
Okay.
When I really had enough for my wife to tell me that I could do it. And that's the way it went.
Absolutely. Awesome. Fantastic.
And luckily it's gone pretty well ever since.
That's awesome. I love it, man. It's the entrepreneurial spirit, you know. Once you get the bug, it never goes away, man. I'm telling you, once you make your first buck on your own, it's like you got to just keep doing it and doing it again, and you can write.
And it ran in my family. I don't know if it's the same for you, but my dad had his own business. Both of my grandfathers had their own businesses. A few of my uncles had their own businesses. So it was in my blood before I was even born.
Oh, that's awesome, man. That wasn't the case with me. I think I'm the first one in my family, well, at least my immediate family, to kind of go off on their own. But I think one of my uncles is an entrepreneur. I got some cousins and stuff. But for the most part, I'm, I guess, the main person. So awesome. Yeah. Really cool. So it sounds to me like you really love crunching numbers.
I do. I can't really picture myself doing anything else. I always try to think about what I would do if I wasn't an accountant. And short of being in the NFL, which clearly I'm not going to be doing anytime soon, I can't really think of anything else that I'd want to do. I mean, I love investing, but I do that passively mostly because luckily I'm fairly busy doing my CPA stuff. So I usually personally leave finding the deals to the professionals, just like everybody should leave their taxes to the professionals.
Absolutely.
But other than that, I can't really picture doing anything else.
Absolutely. I love it. Yeah. Do what you do best and outsource the rest. I subscribe to that 100%. Yeah. So awesome. Yeah. So one more thing before we pivot to the next part of the show here is going to be, you just mentioned something I'm a big believer in, and I'm getting more and more, sold on it every day is passion, doing what you love. Obviously the entrepreneuring world can be tough at times. There's up days, down days and stuff like that. But at the end of the day, sounds to me like you love what you do. So really, it doesn't feel like work, No. It's fun.
You know what? First of all, it gives me the flexibility I just had a baby, as you know. She's 4.5 months old. It gives me the flexibility. My wife has a job in the city working at a school. So she's out off on the road early, right? And it gives me the flexibility to do what I need to do to take the baby to the doctor, if I need to take my dad to the doctor, if I need to go see clients, whatever. It gives me the flexibility to do what I have to do for my business and my family while still supporting my family.
100%. I couldn't agree with you more, man. Time for the freedom to kind of set your own schedule. Once you kind of do it, you can never go back, man. And that's why you got to work through the tough times. You got to be persistent because being able to write your own schedule, there's nothing like it. It's the best.
There's days that I wonder how I'm going to get the work done, right? And I bring it up to my wife every year. I say, I don't know how I'm going to do it. How's it going to get done? And she tells me I'm crazy and tells me that every year I say this and every year the work gets done, which is true. She's right. And then there's some days, like in the middle of the summer when I'm not as busy, thinking to myself, how am I going to pay the mortgage?
Yeah, right.
But it happens, you do what you have to do. There's just those up and down days.
That's it.
If there's any entrepreneurs watching, just know that there's others out there going through the same struggle that you are. It's not just you.
Absolutely. I'm so glad you mentioned that, because I think a lot of people, they see, I guess, quote unquote, successful people, or I think the internet does a really bad job at demonstrating reality. So a lot of people only go the highlights and the watches and the cars. And I have nothing against that. I like those things too. But at the end of the day,
sure.
Not every, you're going to get kicked in the teeth. You're going to have to be persistent. Even these guys who are showing you a lot of the flashy stuff, like I said, nothing against that. They have down days. They have turkeys, which I call bad deals. They get their teeth kicked in, and that's just part of the game, guys. So if you're struggling, if you're out there and you're scrapping and you're trying to scrape by, listen, everyone goes through it, and you got to just persist and learn from your mistakes. So
Elon Musk just came out yesterday or today or something saying they have to cut 7% of their workforce.
Yeah.
So he's having a bad day.
Absolutely, he's having a bad. And 7% of a company that big is a lot bigger than losing some marketing money, or you losing one client or something like that. So everyone's problems are relative. So fantastic, fantastic. So Andrew, let's get into kind of your current focus. Obviously, the accounting world is very big and complex. So what's your current niche? Obviously, I think we all kind of know the answer, but let's kind of drill a little bit deeper on your current focus here in your CPA practice.
So, like you said, it's totally true, right? The accounting world can mean so many things, so many things. There's auditing. There's private accounting where you work for a company, internal. There's internal auditing. There's external auditing. With all of those things I want nothing to do with, right?
Yeah.
I'm not the pro at those things, right? So what I focus on is taxes and sort of accounting with your QuickBooks and stuff like that for your small businesses, individuals. And even in that realm, there's so many different types of businesses that people can focus on. So even within there, there's different things, right? So a lot of my clients, I would say a good third of my clients or more, are dealing with real estate, right? Whether they're investors or realtors, and some of those are meshed together. Some are realtors and investors.
Sure.
Attorneys. What else? Insurance guys. Just the whole realm. Title guys. The whole realm of real estate is one of my main focuses. I have doctors and some other random clients also, but some of my main clients are definitely real estate related.
Okay. So really it sounds to me like your main focus is small businesses with the specific practice and the niche of real estate. And that could be investment real estate, like what I do. There's brokering, attorneying, that's even a word, insurance, stuff like that. A lot of maybe people who are, maybe they sell insurance, but they're not a employee. They're commission only insurance. So stuff like that. So that sounds to me like that's kind of your niche that you've carved out here in the marketplace.
Yeah. And then a lot of the real estate investors are not just real estate investors, right? Some of them, a couple of my new investors also are working like in schools, or one of the guys that's a new client of mine is actually a scientist. He has like a master's in some science that I know zero about. And he does a lot with I think vaccines and cancer research and stuff like that. So he's very smart and also getting into real estate.
Okay. That's awesome. I love it. And that's the thing with real estate, guys. I mean, you're hearing it from Andrew right now, guys and gals. You don't have to be a full-time real estate investor to make money in real estate. You can do it on the side. I mean, Andrew does it on the side. He's primarily an accountant, and he invests in deals that operators run.
I'm honestly not even a part-time real estate guy, really, right? Because when you think about it, I'll have people come to me with deals, and a lot of times I'll send them to you or to Larry or to Larry and Frank and whoever, and they'll look at the deals and you guys will come back to me and say yes or no.
Yeah.
Whether you guys would invest in them. If you wouldn't, then I might be out. If you would, then I know that you guys are further into the game where you could pick out a good deal. And if it's worthwhile for you, maybe it's worthwhile for me.
Absolutely. Yeah, absolutely. And that's cool. I mean, you're taking a lot of opportunities that might come your way, and you know that, hey, that might not be your specialty or something, and you're sending it to some guys who do this a little bit more full time. And I think that's a great way to collaborate with others. So,
and even in the accounting world, like also like the payroll.
Leo, look at that. Yeah.
Payroll, I sent it to Leo.
Yeah.
Right. If anybody's looking for their payroll, we have a guy. But it's just everybody has their spot in the world, and even in the accounting world, everybody has their spot.
Absolutely. Absolutely. Everyone, do what you do best. I've said this on the show, do what you do best and give the others that are, do what you do best, outsource the rest. Give what you're good at your all. And then if you're not good at something or it's not your niche, just give it to someone who's good at it and you guys can all collaborate that way. So
the thing is, I see a lot of people trying to do their own taxes, and it's, I know.
God, it makes me cringe.
They're trying to save a few bucks now, but either missing out on deductions or doing it incorrectly and getting a letter and owing a ton of money. And it's just to save a few bucks now, they're costing themselves.
It's amazing, right? It's amazing. And what do they call that? Tripping over pennies on your way to dollars or something like that.
Yeah, exactly.
Crazy. They're pound or penny wise and pound foolish. There's so many analogies.
Exactly.
It's stable, but awesome. So Andrew, I really like how you kind of carved yourself your own niche in the marketplace. So let's kind of talk about something. I have an audience. I bet you a lot of them are flippers. Definitely have some rentals here, but most of, I think, my audience are flippers or wholesalers, which is when you're just buying properties and assigning contracts. So let's talk about some of the tax. Let me see here. So some benefits to flippers in terms of flipping being a very tax-heavy, I guess, niche in the real estate game. So what are some things that flippers or active income earners in the investment real estate game, what can they do to obviously legally minimize their tax liability? What are some strategies and tactics that they can take away from this interview that they can implement right away?
So the first thing is, if you're active in a business, right, like I'm active in being in accounting, you're active in real estate, right, and managing and doing projects, your net income could be subject to the Social Security and Medicare tax, right? That's shaving 15.3% off of your net income, right?
Oh,
a lot of money. That could be
a lot of money, yeah.
Right? So one way to legally save money there is to have your LLC, if you're active, taxed as an S corporation, right? You could really be saving a lot of money there. And this is how, right? The net income from the S corporation is not subject to the 15.3% Social Security and Medicare tax, right? That being said, the government, like we discussed, the government's going to come and say, okay, fine, but you're not totally off the hook, right? Mm-hmm. So, and by that I mean, you need to pay yourself what they call a reasonable salary from the business, where they're getting their Social Security and Medicare tax, right? So if you're making $100,000 net income from the business, we generally, in round numbers, and it might be different for different specific situations, but in round numbers, we're talking like $50K in salary and $50K in net income, right? With a little bit more in expenses, so it's not exactly that round. But so you're saving 15.3% on $50K of income, right?
That's a lot of money.
That's like $7,500.
Yeah.
That you can put in your pocket towards your next deal.
Absolutely, 100%. So that's huge.
A lot of money.
A lot of money. Absolutely, it's a lot of money.
Okay. Thing number 2 that you could be doing to save a lot of money is if you have any kids or family members that are not currently working, right? You could pay them a little bit of salary to help you in your business, whether it's helping you with marketing or helping you with filing or just helping you do some random stuff around the office, right? So let's say you're making $100,000, right? And your tax bracket is, let's say, somewhere in the 20s, 20%, 22%, 24%, right? If you pay your let's say your kid 10 grand in salary, and there's limits to this, and they actually have to be helping your business and everything.
Sure.
So you can pay random people. But let's say they're helping you in the business, right? Sure. 10K, they have to pay the Social Security and Medicare, right? $1,500 on the 10K. But then there's certain limits where they'll be paying no other tax on their income, right? Up to about 10K or so of income. So you're paying them the 10K, they're paying $1,500. On that 10K, you'd be paying $2,500.
Yeah.
So again, you might not retire off the savings, but it could be a few extra bucks here and there to go towards your next deal, right? And every little bit helps.
Absolutely. 100. And it's the little things that add up too. I'm glad you brought that up, Andrew.
For sure.
Yeah. Because you guys got to see, I mean, when I got started, I mean, in the beginning, we weren't doing as many deals and the revenue wasn't as high, but as you start to grow, you're going to see, more money can mean more problems sometimes. So if you don't have your tax situation accounted for, you could be in a real jam. So this year I actually connected with Andrew through a mutual friend of ours, Larry Friedman, who's actually going to be a guest on the show next week. And, nice. So I said, Andrew, I need some help with some taxes because this year I've made a lot more money than I did in the previous years. So you guys gotta take this stuff seriously. I know some people are like, oh, taxes, I don't care about it. It's boring. Guys, this is real stuff here. You got to take this stuff seriously. You got to be as knowledgeable as you can, and you need to align yourself with people who are way smarter than you when it comes to this stuff, such as Andrew, because guys, this stuff is serious about your business. And to me, you can save $7,500 on taxable income. I mean, that's a lot of money that you could, like he said, put towards the next deal.
The problem is, right? So the $1,000 you save on paying your kids, this, that, and the other thing, the big players might say, well, that's not a ton of money. But imagine an extra few grand to put in your next deal, which then becomes a good deal. And that a few grand turns into 5 to 6K that you could then flip into the next deal. Yep. And that 6K becomes 10K, which then makes or breaks being able to do the next deal. 10, 15, Absolutely. 20, right? It adds up. Small things can add up in ways that you don't even know.
Absolutely. 100%. It's all about that cumulative, that compound effect. And you got to do it with your taxes. I'm a big believer in, there's a great book out there called The Compound Effect by Darren Hardy, and he talks about your choices. But you got to take the compound effect and use it in other areas of your life with taxes, being smart, making sure you go through your books. Like every Sunday I do my accounting for the week. I look at my numbers, make sure they're accurate. So then when I send them over to Andrew in a couple of weeks, they're all, they've been accounted for a whole year. Yeah. So maybe there's some little adjustments. Yeah.
That's a big problem that people don't realize is maybe it doesn't have to be every week. If you want to, you can, sure. But it shouldn't be once a year or twice a year where you're doing books. It just, you could miss so many opportunities.
Absolutely.
Right?
Absolutely.
And one last little tidbit before we move on, I guess, is the self-directed IRA.
Okay.
Right? I have a self-directed IRA through my accounting practice where I'm putting away my retirement funds, and a portion of that money is going into deals, right? So if you have a standard SEP IRA or a standard 401k, right, or any standard IRA, your options are limited to some Vanguard funds and some Fidelity funds, and they're very good, and you should have some money there, right? But it's all about diversifying, right? And in the self-directed IRA, I'm able to stock away some money that I could then put into some real estate deals, whether it's a flip or a buy and hold, or some private money that I'm giving to a deal or whatever.
Yeah.
Just keep in mind that you need to have the proper trustees and everything there to make sure that you're following the rules to a T. Because if you're not, and this isn't saying you shouldn't do it, this is just saying that you should have the proper people in place. If you don't follow the rules, it could be a price to pay for you.
Absolutely. Absolutely. You got to make sure you're doing everything by the books, no pun intended. So Andrew, when you say a proper person dealing with that, do you mean a self-directed IRA custodian?
Yes, exactly.
Okay.
Exactly.
So
And
one of these companies, like Quest IRA and stuff like that.
yeah, yeah. So they help you send the funds out, and there's fees for all this stuff, but they help you send the funds out. They help you get the funds back and properly put them back in the IRA. Because one of the problems is if you do a deal through the IRA and then you get the money back to you and keep it, that's a distribution from the IRA.
Yeah.
If you're 59 and a half, not only are you paying tax, but you have a penalty on that too.
Absolutely.
Absolutely. And that penalty could be 10%, and that could kill the deal.
Absolutely it could. And then that's just, you're kind of wasting your time with the whole IRA, because the whole point of that is to sit and wait. And once you're 59 and a half, you reap the benefits. So you guys, this is another, emphasis on, guys, you got to study up on this stuff. You got to align with the right people. You got to do your homework on taxes and IRAs and strategies to save money, because at the end of the day, I remember reading Rich Dad, Poor Dad back when I got started, and he's like, making money is cool, but keeping it's even cooler, right? So it's not about how much you make, it's about how much you keep, right? And obviously doing that legally, morally, and ethically. So
awesome. And the thing is, right, that you have to know that you're not an expert in everything.
Exactly. Humility.
Just that's the most important thing to understand is do not try to be an expert in everything.
100%.
It's going to hurt you in the end.
Absolutely.
98% of the time, trying to be an expert in something you're not an expert in will cost you more than it'll save you.
Absolutely. Don't be a jack of all trades. That is fantastic advice. Guys, if you don't take anything away from this interview except for that, I mean, that one tip alone can save you guys a lot of time and potentially money, because guys, don't try to, like Andrew said, I'm going to reiterate what he said. Don't be an expert in everything. Align with pros. Make sure, do what you're good at, whether it's finding deals or negotiating or, being a good broker, and then have good people on your team that you're aligned with, accountants, attorneys, title companies, vendors, stuff like that, guys, and work together with others. You don't have to do it all by yourself. And Andrew,
I'm in a deal.
Go ahead.
I'm in a deal now with Larry, right? And he was teetering back and forth on whether to keep it or whether to flip it. It's a 2-family.
Okay, I think I know which one you're talking about, actually.
Yeah. Keep it or sell it. Keep it or sell it. And we've been talking about this for months. And I said to him, look, I'm happy to review the numbers with you since I'm a numbers guy. But in the end, you're the real estate expert on this one. So the two of us have to decide this together. And he keeps coming to me and saying, well, what do you want to do?
Yeah.
And I'm like, dude, this is something we have to look over and discuss together. It's not only my decision.
Yeah, absolutely. Yeah, it's a mutual thing, especially you guys both obviously have your time and money involved in the deal. So, it's all about being on the same page and having consistent communication. Obviously, I'm familiar with the deal is a good deal regardless. So whether you keep it or hold it, you can't really lose. So awesome. So Andrew, I really appreciate those tips on active income earners. So let's pivot into the back half of the show where we're going to get a little bit more into some benefits of owning long-term rental property or just rental property in general. And how is that income taxed? And why is it almost more beneficial to own, buy, and hold real estate instead of, fixing and flipping and wholesaling and wholetailing and wheeling and dealing your way to, I guess, financial freedom? So why would it make more sense to own rental properties, especially with depreciation?
So the big thing about the rental properties is, number one, you obviously hope they go up in value over the long term. So you have the appreciation, right?
Absolutely.
Number two is you get that money coming in hopefully every month, right?
Absolutely. Mailbox money.
You're collecting the checks while you hopefully have an appreciating asset.
Yes.
Right? Every month. And I just went to a thing the other day with Section 8. One of my clients in New Jersey has a ton of Section 8 in Newark, right?
Okay.
And it's a good portion of his portfolio. And not only is he getting paid, the government is guaranteeing it.
How do you lose?
How do you lose?
Yeah.
You almost can't, right? So that's where you're getting a lot of bang for your buck there in holding the properties, right? And then on top of that, you're getting the cash flow and you have the depreciation. So you're not paying a lot of tax on that cash flow, right? Because you have the depreciation and some other expenses to write off against the income.
Okay, so what is that? So I want to kind of unpack that, because that's where a lot of investors get very interested in the rental properties. And actually, guys, if you read Rich Dad Poor Dad, if you haven't, I would recommend you go read Rich Dad Poor Dad. But the guy talks, Robert Kiyosaki, the author in the book, talks about really cash flow instead of cash. I don't think he mentions flipping houses one time in that book. He talks about buying assets that pay you cash flow every month. So Andrew, why? So can we break down depreciation? What does that kind of mean? I know there's a certain time period you can depreciate the asset for, and how does that lower your tax liability? And let's try to give everyone an example, whether it's a property we've done or just a general, multifamily property. How can we unpack this thing and show people literally how you can, pay less in taxes based off depreciation? So
the idea behind depreciation is you have an asset that's going to last a long time, right? Mm-hmm. So you can't expense that asset right away. Like a multifamily home that you're paying 50, 100, 200, 300K for, right? It doesn't make sense to expense that right away.
Understood.
So the basics of depreciation are you're taking a chunk of that every year, depending upon what the asset is. And there are some assets that some shorter term assets could depreciate pretty much right away with Section 179 expense. But generally speaking, with these commercial and residential properties, you're depreciating them over 27 and a half or 39 years, right? So what that basically means is you're taking a chunk of the amount that you paid for it and expensing it every year against the income, right? Okay. That's greatly reducing or eliminating maybe the amount that you would owe in taxes against that income.
Okay, that makes sense. So you're depreciating the building.
Yeah, but within depreciation, right, generally speaking, if you have a multifamily house, right, you'll be depreciating that over 27 and a half years, right? Sure. So then there's something called cost segregation. Cost segregation says we're going to basically look at this property and we're going to depreciate some of the asset sooner. Because if you really break it down, all of it shouldn't be done over 27 and a half years. There might be some chandeliers in there. There might be some appliances in there that we could depreciate sooner, more quickly. So you're getting a chunk of the expense basically quicker. So if you have a decent portfolio, it's something to consider to get some of those expenses sooner. And you might say to me, well, I've had this property for 3 years, so I can't do a cost segregation anymore. That's not true. You could catch up. There's a way to catch up the depreciation that you just thought you lost because you didn't do the cost segregation right away.
Interesting. So there's many ways you can kind of skin the cat when it comes to these, the rental properties between the depreciation and the cost segregation. And really the main thing that I want people to take away is let me give you an example, Andrew. I want to see if this is correct or incorrect. And if it's incorrect, you could correct me on where I made the mistake. So let's say, for example, I just bought my goal is to buy more multifamily this year, small multifamily, and then pivot up into bigger commercial buildings. So let's say I buy a building, and that building at the end of the day, after all expenses are paid and the debt, the banks are paid, that building nets me $30,000 a year of net operating income based off of the cash flow after the debt service. So before tax cash flow, that's what we can call that. So let's say I'm on the hook for $30K of income right now, and then this income was earned via investments. This was not buying and selling property. This was basically the dividends from the asset. So let's say $30K right now. How much depreciation can I write off on that $30,000, and how much taxes, quote unquote, am I going to probably pay on that?
So it sort of depends on how much you paid for the asset.
Okay.
Let's say you paid, just for round numbers, $275,000 for the property.
Yep.
the 27 and a half year depreciation would allow you to take 10K a year.
Of
right?
Depreciation, yes.
Depreciation.
Okay.
And that's if you don't do the cost segregation.
Okay.
Do the cost segregation, you might be upfronting some of that extra depreciation, but then obviously you'd have less later on.
Absolutely. Absolutely. So basically, so what you're saying there, so $30,000 net income, now we're taking 10K right off the table now, and now we're down to 20 just via depreciation, right?
Yep. And then the tax you'd pay on that, it depends on your brackets, but on that 20K, you could be expecting to pay maybe as low as close to nothing, but probably not, depending upon your brackets, but probably somewhere in the vicinity of, let's say, 5K, 7,500, something like that.
In taxes. Is that because that taxes is not active income? It's a different type of income, so therefore the tax is not it's not like it's my primary job. This is almost investment income. So is that looked at by the government from a different lens?
Yeah. So the idea is on the passive income, you're not subject to the Social Security and Medicare tax.
Okay.
Just the state, federal, and if applicable, local income taxes.
Okay, understood. So you don't have to pay because it's not your active income. It's almost like a side thing. Very good. Yeah. So guys, this is another point we're trying to hit here. You might be buying and selling property. You might be a realtor. You might have a 9-to-5 job. Whatever you're doing, listen to this. Get involved in investment real estate, because if you do it long enough, it is just, you can't really lose doing it. Obviously, there's risks associated with it, but for the most part, there's so many benefits to being involved in this business for the long term. So
you don't have to start at the top.
No.
And you won't start at the top.
No, not at all.
That's okay. That's okay. You have to start somewhere.
Absolutely.
If you're thinking about doing it, just talk to people that you trust and just start.
Absolutely. Just begin. You'll figure out the rest as you go. So you can't I heard this one cool analogy, and then we'll pivot to the last half of the show, or the last quarter. You can't wait for all the lights to turn green at once, because that's never going to happen, right? You're going to wait for one light to turn green, then you're going to get there, it's going to be red, then you got to wait. So you can't expect all the lights to be lined up green. You have to stop and go. You're going to figure it out as you go. So guys, don't get analysis paralysis, and just do a little bit every day, and you'll be surprised on where you end up in a couple of years when you just take
for sure
a couple steps forward, no matter what you're doing. So Andrew, fantastic information on that. I'm sure everyone has gotten a ton of value so far. So I was going to talk about the biggest mistake investors can make. We actually already hit on that. It's basically trying to do it all by yourself, not hiring a professional when it comes to taxes or attorneying or whatever. So we're going to
I think it really is.
Yeah, that's it. I think that's the big mistake. I think we hit on that already. I think, guys, if you're not getting the pros on your team, you got to do it. It's going to be worth it in the long run. So let's pivot into the last part of the podcast today. And it's actually a personal question I have, and it's going to tie in a lot of different things that we were actually talking about today. So to share with the listeners, I recently turned my limited liability company, Velocity House Buyers, into basically I turned it into getting taxed as an S corporation. So now I pay myself a salary, and I have payroll tax, and I'm involved in different types of accounting now with my own company. I have a few companies, but this company, my main business, is an LLC, but it's taxed as an S corp. So now my question to Andrew, which I was going to email him, but I figured I got him on the show, we might as well answer it in front of everyone, is Andrew, I just flipped the property on Tuesday, and my net proceeds, I think I did a deal with another person who was a JV, so we split the equity 50-50. I think the income I took in on that was like $4,300 net to me after attorney fees. And my question to you was, now that I have an S corporation, basically, how do I account for that? Because normally, I'll give you an example on what I used to do, and now I want to just make sure I'm doing it the right way now. Normally, what I would do when I had the LLC and it was just going right down to my personal income tax on a Schedule C, is I was just taking, all right, X amount of dollars was made in the company, percentage for taxes, percentage in my checking account, percentage in my savings account, percentage in my, giving to someone else account, et cetera, et cetera, et cetera. Now that I have a salary and payroll I have to account for, how do I do that where, like, if I pay myself, quote unquote, does that have to flow through certain capital accounts to get to my personal checking account? Or that was my question for you. And the money is still in my business account. I'm going to distribute it once we get done with this interview. So how do I start doing that? Because we have like 15 properties we're flipping right now. So the pipeline's going to keep cranking. And I just want to make sure I'm doing this the right way going into the new year. This is getting filmed in January 2019.
Yep. So if you're an S corp, you have to remember what we discussed before in saying that you have to pay yourself a reasonable salary, right? So if you're netting a certain amount from a deal, like 40,000 or so, right? Of that, we would say that I would suggest that half would go to salary, and we would tell Leo what the number we decide, right? And he would tell you how much money you have to have ready. He would send some of that money back to you as a salary. Some of it would get withheld as taxes that you have to pay in, right? Mm-hmm. So 20,000, you're going to be paying out something in the vicinity of 23,000, right? Some of it's payroll taxes, some of it's withholdings, and some of it's going to come back to you as a salary.
Sure.
And then the other, let's say 20 or so thousand, is yours free to do whatever you want to, because that's going to be taxed as a net income of the business anyway. So from that 20,000, maybe you should have 5-6K for taxes. Yeah. And the rest is yours to either put in the next deal or pay for your apartment or your vacation or really whatever you want to do with it.
New watch.
Yep.
Whatever. Okay. So basically just make sure when I'm ready to tell Leo or you or any tax professional, I want to make this very general because we have obviously a lot of people listening. So basically, let's say, take the money. I have a certain percentage I want to pay myself just to have. I need money to live, for the rent, for checking account, for the groceries. Make sure that when I tell the professional, hey, this is what I'm going to allocate for my salary, I got to run it through the payroll system, because then some of that's going to get taken for payroll taxes and Medicaid and stuff like that.
I would say that the quote unquote reasonable salary should be decided with your tax person, because it's kind of like a strict thing that we need to make sure we're doing enough that the government will be happy, Absolutely. But not too much where you're paying in more than you have to.
Absolutely.
And then that doesn't mean that's all you could take out of the business. That's just the salary portion. If you need more money out of the business, you just do a distribution.
Yeah, absolutely. And that's subject to taxes too, though, right? The distribution.
Only because it's taxed as the net income of the business.
Yeah, that's the profit.
Yeah, you're not paying any tax on top of that for then distributing the money.
Understood. That makes complete sense. Okay, so
it's not like getting a dividend from your Disney stock or anything like that. Okay. It's a little bit different than that. Okay. And if this is unclear at all, if anybody's listening or watching and this is unclear, do not try to figure it out on your own. You won't.
Yes. Very good advice, Andrew. I'm glad you mentioned.
I'm happy to talk.
Absolutely. And that's actually, I appreciate that, Andrew. Super helpful for me. A little selfish personal question there. So anyhow, so Andrew, we've talked about a lot of things today. I think a lot of the listeners, no matter what they're in, whether they have a job, they want to get into real estate, they're in real estate, they've definitely gotten value from today's episode, even if it was about the early parts where we're talking about just wheeling and dealing and the up days and the down days of being an entrepreneur. So Andrew, can you talk a little bit about your firm and your services, and then what would be the best 2 or 3 ways they can get in touch with you if they want to inquire more about your services?
So basically, as we discussed a little bit, I provide tax and bookkeeping and accounting services for my clients. Getting their taxes done, planning for their taxes, making sure we're doing everything we can to save on their taxes, helping them plan for their retirement contributions, and all of that kind of stuff, right? On top of that, I make sure you're tied into the right professionals for your payroll, for your having your retirement plan set up, having the correct insurance, whether it's life insurance, the builder's risk policy on your flip, so on and so forth. So I'm getting you, on top of doing what I do, I'm getting you in touch with the right professionals for everything else.
Absolutely. Absolutely. Love it.
The best ways to get in touch with me are my number is 973-879-9111.
Repeat that one more time, just so in case people.
Sure, that's 973-879-9111.
Fantastic.
My email is akabatchnick@gmail.com. Can everybody see my name or no?
On YouTube they will, but if not, what I'll do, can we spell it out and then I can put it in the description too?
My email is akabatchnick@gmail.com. I'm going to leave you to yourself to figure out how to spell that. No, I'm not. No, I'm not. It's A-K-A-B as in boy, ATCHNICK@gmail.com.
All right. Perfect.
And my website is andrew-cpa.com.
Andrew-cpa.com. That's pretty.
Can't get any easier than that.
Love it. Love it. Andrew-cpa.com. You probably paid a fortune for that domain name.
I wish. Thank God I didn't.
Oh, man. That's awesome. You can flip it to me. I'll wholesale it for you. Anyway, Andrew, I really appreciate your time today. You dropped a tremendous amount of value for everybody. I think we're all a little bit smarter, whether it's listening to you or speaking to you. And I
hope it helps.
Awesome. Fantastic, Andrew. We'll talk to you soon. All right.
All right. Thanks for having me. Talk to you soon.